The IRS just released the 2026 tax brackets and retirement contribution limits, and these changes could save you thousands in retirement or cost you if you're not prepared. If you're in your 50s or early 60s and getting serious about retirement, this is the perfect time to understand these changes and adjust your strategy. I'm PJ Gibbs with Trello Wealth, and as a financial advisor with over 10 years of experience, I've helped countless families navigate these exact changes. In today's video, I'm breaking down what's changing for 2026, how it impacts pre-retirees, and showing you a strategy to maximize your savings in that critical decade before retirement. Let's dive in. The IRS has announced the 2026 tax brackets, and while the rates themselves stay the same, the income thresholds are adjusting for inflation. This means more of your income can fit into lower brackets, which could save you hundreds or even thousands of dollars. For single filers, the 10% bracket now covers income up to $12,400. The 12% bracket extends to $50,400, and the 22% bracket goes up to $105,700. For married couples filing jointly, these numbers double. Here's why this matters for pre-retirees. Let's imagine a hypothetical scenario where a couple in their early 60s has taxable income of $95,000. In 2025, a portion of that income would be taxed at the 22% rate. But in 2026, with the adjusted brackets, more of their income stays in that 12% bracket. That's real money staying in your pocket instead of going to the IRS. The standard deduction is also increasing. For married couples filing jointly, it's going up to $32,200 from $30,000. For single filers, it jumps to $16,100. If you're 65 or older, you also get an additional standard deduction, which helps reduce your taxable income even further. Now, these adjustments happen every year due to inflation, but understanding exactly where you fall into these brackets is critical for smart tax planning as you approach retirement. Now, let's talk about the contribution limits for 2026, because these are getting some meaningful increases. The 401k contribution limit is going up to $24,500, up from $23,500 in 2025. That extra $1,000 might not sound like much, but you're in your peak earning years. Every dollar you can defer matters. And for those of you age 50 and older, the standard catch-up contribution increases to $8,000 in 2026, up from $7,500. That means you can contribute a total of $32,500 to your 401k if you're 50 or older. Over a 10-year period from age 55 to 65, maxing out these contributions could add over $325,000 to your retirement savings. And that's before any investment growth. But here's where it gets really interesting. Under the Secure 2.0 Act, if you're between ages 60 and 63, you qualify for a super catch-up contribution of $11,250 instead of the standard $8,000. That's an extra $3,250 per year during those 4 years. Let's say you're 55 years old right now, planning to retire at 65. If you max out your contributions, including that super catch-up from ages 60 to 63, you could potentially contribute over $300,000 from your own salary deferrals alone over that decade, not counting employer matches or investment growth. IRA limits are also increasing. The standard IRA contribution limit goes up to $7,500 for 2026. And the catch-up contribution for those 50 or and older increases to $1,100 for a total of $8,600. This is the first time the IRA catch-up limit has been indexed to inflation, so we'll see it continue to grow over time. Now here's a change that's catching a lot of people off guard. Starting in 2026, if you make more than $150,000 in FICA wages, any catch-up contributions you make to your 401k, 403b, or governmental 457b must go into a Roth account on an after-tax basis. This is a significant change from current law, where you could make catch-up contributions on a pre-tax basis. Let me explain what this means. Let's say you're a 55-year-old earning $200,000 per year. You want to make the full $8,000 catch-up contributions in 2026. Because your income exceeds $150,000, that entire $8,000 must go into a Roth 401k account. You won't get a tax deduction for it today, but it will grow tax-free and you won't pay taxes on it when you withdraw it in retirement. Now, this isn't necessarily a bad thing. In fact, for many high earners, having some Roth money in retirement can be incredibly valuable for tax diversification. But here's a catch. If your employer's 401k plan doesn't offer a Roth option, you won't be able to make catch-up contributions at all. So you need to check with your HR department or plan administrator to make sure your plan will be ready for this change. This rule is based on your prior year's wages. So for 2026 catch-up contributions, they'll look at your 2025 wages to determine if you exceed the threshold. The $150,000 threshold is also indexed to inflation, so it will likely increase in future years. Speaking of Roth accounts, let's talk about Roth IRA contribution limits and income phase-outs for 2026. The basic contribution limit is $7,500 if you're under 50 and $8,600 if you're 50 or older with the catch-up. But here's where it gets tricky. You can only contribute to a Roth IRA if your income falls below certain thresholds. For 2026, if you're single, the phase-out ranges between $150,000 and $168,000. If you're married filing jointly, it's between $242,000 and $252,000. Once your income exceeds the upper limit, you can't make direct Roth IRA contributions at all. Now, if you're a high earner who exceeds these limits, that doesn't necessarily mean Roth IRAs are off the table. You can still use a strategy called a backdoor Roth IRA, where you contribute to a traditional IRA on a non-deductible basis and then convert it to a Roth IRA. This is completely legal and IRS approved, but you need to be careful about the pro rata rule if you have other traditional IRA balances. The beauty of Roth accounts, whether it's a Roth 401k or Roth IRA, is that they give you tax-free income in retirement, no required minimum distributions during your lifetime, no taxes on withdrawals, and you can leave them to your heirs tax-free as well. Let me come back to the super catch-up provision because it's one of the most powerful tools for pre-retirees in that final push just before retirement. If you're between ages 60 and 63, you can contribute an extra $11,250 as your catch-up to your 401k instead of the standard $8,000. That's an additional $3,250 per year for 4 years, or $13,000 total. Let's run through a hypothetical scenario to show the impact. Imagine someone who's 60 years old with $500,000 already saved in their 401k. They plan to retire at 64. They max out their contributions with the super catch-up for those 4 years. Assuming a conservative 7% annual return, they could add over $190,000 to their retirement savings just from those contributions and growth over that 4-year period. Now, this is a hypothetical example for illustration purposes, but you can see how these final years before retirement can be absolutely critical for building your nest egg. Many people I work with are in their peak earning years during this time. The kids are out of the house, the mortgage might be paid off, and they finally have the cash flow to really maximize their savings. The catch is, not all plans are required to offer this super catch-up provision. It's optional for employers. So again, you need to check with your HR department to see if your plan has adopted this feature. So how do you pull all of this together into a cohesive strategy? Here's the framework I use with families who are 10 years away from retirement. First, max out your employer match. This is the closest thing to free money you'll ever get. If your employer matches 50% or 100% of your contributions up to a certain percentage, you need to contribute at least that much to capture the full match. Second, fully fund your health savings account if you have a high deductible health plan. For 2026, you can contribute $4,300 as an individual or $8,550 for a family, plus an extra $1,000 if you're 55 or older. HSAs have a triple tax advantage: tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. Think of it as a stealth retirement account. Third, max out your 401k contributions, including catch-ups. If you're 60 to 63, use that super catch-up. Even if the new Roth rule applies to you and your high earner, that's okay. Having Roth money in retirement is incredibly valuable for managing your tax situation. Fourth, consider a Roth IRA or backdoor Roth IRA if you're eligible. Having a mix of pre-tax and Roth money gives you flexibility in retirement to manage your tax brackets more efficiently. Fifth, if you have extra cash flow beyond these accounts, consider taxable brokerage accounts invested in tax-efficient index funds. You won't get a tax deduction going in, but you'll have access to the money before age 59 and a half without penalties. And long-term capital gains rates are typically lower than ordinary income tax rates. Finally, think about Roth conversions. This is where you take money from a traditional IRA or 401k and convert it into a Roth IRA, paying taxes on the conversion in the year you do it. The sweet spot for Roth conversions is often in those early retirement years after you stop working, but before you start Social Security and required minimum distributions. During those years, you might be in a lower tax bracket, making it an ideal time to convert portions of your traditional retirement accounts to Roth. For a 55-year-old planning to retire at 65, the next 10 years are absolutely critical. This is your window to maximize contributions, take advantage of catch-up provisions, and set yourself up for a tax-efficient retirement. The difference between someone who maximizes these strategies and someone who doesn't could easily be $500,000 or more by the time they retire. Look, I get it. This is a lot to process, and everyone's tax situation is different. Tax planning isn't just about filing your return in April. It's about looking ahead through the windshield, not just in the rearview mirror. If you're in your 50s or early 60s, these changes matter for you. The 2026 updates give you opportunities, but only if you understand how to use them. At Trello Wealth, we help families and retirees simplify financial complexity with personalized planning and disciplined investment management, so they can move into retirement with clarity, confidence, and peace of mind. If you want to schedule a call to see if we can help you maximize these opportunities and build a tax-efficient retirement plan, visit the link in the description. You can also download our free retirement readiness checklist.